So good afternoon, everyone. We will get started very soon as participants are signing on right now. So we will start very promptly at around 1 o'clock. And while you are waiting for the seminar to start, there is a poll. Feel free to participate. Good afternoon, everyone. Thank you for joining this afternoon for our next Knowledge Labs webinar. So before we start, I would like to take a moment to acknowledge the land McMaster University is on. McMaster University recognizes and acknowledges that it is located on the traditional territories of the Mississauga and Haudenosaunee nations, and within the lands protected by the Dish with One Spoon Wampum Agreement. So I'm so excited to see a number of people joining. Actually, we have quite a good turnout today from all over North America as well as the world. So thank you so very much for supporting DeGroote and our programming. Now, today we have a very exciting topic lined up for you. Something that we hear a lot about in the news and in our conversations. And also larger organizations are not only facing pressure about how to align their money with meaningful causes, but we as individual investors as well. Today, I'm the moderator. I am Dr. Candice Chow, Assistant Professor at DeGroote School of Business. And joining me here today as our speakers are two of my esteemed colleagues, DeGroote Associate Professors Brent McKnight and Professor Kevin Veenstra. They are here to talk about their findings from the research over 3 years, talking to financial advisors and investors on the topic of responsible investing. Now, as you've seen, we have opened some polls, so we'll be conducting interactive polls throughout the presentation today. So please, we encourage you to participate. Now, I'd like to share with you the background of my two esteemed colleagues. First is Professor Brent McKnight. He is the Associate Professor of Strategic Management here at DeGroote. He studies how firms and organizations address complex societal problems. Currently, this interest has led him to undertake research in areas of responsible investing at the retail advisory, the role of firms in community resilience and adaptation to climate change-induced natural disasters, and how nonprofits and firms can improve integration outcomes for refugees. Next is Professor Kevin Veenstra. He is our Associate Professor of Accounting at the DeGroote School of Business. Dr. Veenstra studies the influence of social norms and personality traits on an assortment of phenomena, including career trajectories and corporate financial performance. His interest is driven by his fascination with how individual and group characteristics influence decision-making and related outcomes. So thank you both for being here today. And we very much look forward to what you have to share with us on today's topic. Now, before we get started, there are a few things I want to make sure we go over. There will be a Q&A period at the end of the discussion. So please use the Q&A function included in this webinar so that we can address your questions promptly. Now, there is also a like button. So make sure that if you find the questions intrigue you or you would like to ask the same questions, give it a thumb up and it will actually prioritize some of these questions. I know that some of you have actually submitted some questions as well prior to the conference. So we will get to some of those as well. And some of those will be also discussed during the presentation. Now, as a reminder, the purpose of today's session is not to provide investment advice. I know you guys are all very keen to know about some tips, but do refrain from asking questions related to like trading platforms or stock tips, etc., etc. We'll take this another time. Finally, please note that this event will be recorded for marketing and promotional purposes and will be shared within DeGroote, McMaster, as well as with our speakers, participants, and other partners as well. So if you have questions, please contact our marketing and community engagement team if you have any questions. So with that, let's get right to today's presentation. Kevin and Brent, I will turn it over to you.
Great, thank you so much for that excellent introduction, Candice. Do we have those polls up? Can we see the result of the polls? No, yeah, there we are. So this just gives us a sense of who's in the audience and who's here today. So quite a few of you having substantial investments. Can everyone see these polls or should I put them over here? Maybe if I did that, that would help. Yeah, quite a few with substantial investments and responsible investing. Some of you not quite sure, which I think is totally reasonable. And a range of responsible investing knowledge, which is fantastic. And also a range of how you invest. So that's fantastic. So today, Kevin and I are going to walk you through some of our research and what we've done. And we're going to hopefully inform you and educate you about responsible investing, about what it's all about, give you some insight from our research, and then also give you an opportunity to ask some questions and understand a little bit more. So a bit about this research, I guess, to get us going. We've talked to over 105 different people, advisors, investors, industry professionals over the last few years. And that's been really exciting. I'll say that through these interviews, we gained insights into how some advisors and investors think about responsible investing. And it's those insights we're going to talk about today. We talked to a range of different advisors, investors, but I'd say in general, these were those that were interested in responsible investing in some fashion. And so our findings, shouldn't be taken to suggest that all investors across Canada have these same views, but rather that it'll help us to explain the approaches of the still very diverse set of investors and advisors that we talk to. We're happy to acknowledge support by the Social Sciences and Humanities Research Council. And also, if you wanted to follow along with the study, we have a website. It's a little bare bones, but there's some resources. And when we have reports, they'll be going up there. That's at responsibleinvesting.degroot.mcmaster.ca. All right. So responsible investing means a lot of different things to a lot of different people. And I'm going to use an elephant analogy to help us understand what I'm talking about. So if you're a couple of friends, close your eyes and touch different parts of an elephant and try to explain it to the others, it would be challenging. One person might touch the tusk and say, this is smooth. Another touch the tail and say, this is wiry. A third might touch the skin and say, this is a leathery, right? And it'd be hard to come to some understanding of what this thing is without opening your eyes and seeing the full picture. And so that's where we want to start today, is to give you a bit of a lexicon or language to understand responsible investing. Now, some of you, especially those that say they have more responsible investments in their portfolio, this will be a bit of a review. So hold on. But for others, and in our research, we found that quite a few people that were even interested in responsible investing didn't have this lexicon. So for others, this will be new and interesting information. So the first term we're going to go over is ESG, and it's environmental, social, and governance. That's what it stands for. And it refers to three categories of factors or characteristics about firms that help us understand their sustainability or their approach to environmental and social and governance issues. So environmental factors about a firm might be their energy use, their waste, their pollution, how they treat the natural environment. And so, we'd assess a firm on those criteria and those characteristics. For social, that might refer to how they, that does refer to how they deal with different stakeholders, like suppliers. How do they treat them, employees, customers, etc. How is their data privacy handled, for example? And the third is governance, which refers to transparency and how stockholders have ownership and say in the decision-making processes at the firm. So that's a really key term, ESG, and one that we really have to get our heads wrapped around if we want to understand this elephant. The second set of terms are screens. So screens are that first step that help investors match value preferences with their investments. And there's two types of screens. The first type is a negative, or often called an exclusionary screen. And this involves getting rid of companies that don't meet a set of criteria. For example, the really common ones are sin stocks, so-called sin stocks, related to profiting from alcohol, tobacco, gambling, pornography, but it can include other characteristics or other things that firms do that are undesirable by an investor for whatever reason, like fossil fuel production, for example, was a common one that some investors are getting concerned about. The flip side of negative screening is positive screening. So positive screening is referring to selecting investments that demonstrate some desirable characteristics. Maybe it's investing in renewable energy or battery technology, or maybe it's finding the best company in a kind of dirty industry, like the best oil company or the best mining company. Or maybe it's finding firms that are engaging women or equity, inclusion, and diversity on their board and in their top management team. So these are screens. They're very important. They're a way in which our preferences can get translated into the investments that we are engaged in or making. The third term is shareholder engagement or shareholder activism. And this is when institutional investors, large investors like mutual funds or pension funds, that are engaging firms to affect some kind of change. And often this involves a three-stage process. The institutional investor will make an investment. Usually this investment is financially sound, and this also probably has a decent record from a responsible perspective. They want to see some change. So they'll go and talk to the management, engage them on a topic. Maybe it's health and safety at a mine in Argentina that has had some issues, or maybe it's the diversity of their board. Increasingly, we're seeing those kinds of engagements. And they'll say, we'd like you to change things. We'd like you to do something different. And if that tactic doesn't work, often they'll work with a group of other institutional investors and create what's called a proxy vote. So they'll go to a proxy proposal, I should say, and they'll go to an annual general meeting and they'll say, hey, we'd like to formally ask the management to do something. And we'd like you to consider this. And often that vote will get turned down, but if it gets enough voting to show to management that this is serious, that can push firms to take some action. Finally, if there's no movement, to complete that cycle of engagement, firms will, mutual funds and pension funds will say, you know what, we don't want to be part of this anymore. We don't think you're on the right track, and they'll divest. So that's shareholder engagement. It's another very important term when it comes to responsible investing. And the final term is one that's also being used quite a lot, and that's impact investing. And impact investing, really distinguishes itself from responsible investing in that we're seeking intentional environmental or social improvements. And often, almost required in this, is that it's additional to what would otherwise have been created. So this can take many different forms. It can take a direct investment in a nonprofit or a social enterprise. It can be making an investment in a fund that makes those kinds of loans or investments in nonprofits or social enterprises. A good example of that is in Toronto, we have the Mars Center, and they partner with the Heart and Stroke Foundation and Public Health Agency, and they launched a lifestyle change program that will help at-risk seniors lower their risk of cardiovascular disease. And so this is an impact bond fund that will return some impact, social impact, in the terms of health for individuals, and a return for investors as well. But the important part is that intentional desire to improve a social outcome. Okay, so that's the language, and why we really wanted to start with that is, one, it's often kind of misunderstood, but also we think it's the foundation for a lot of misunderstandings. First of all, advisors and investors alike struggle to understand these terms. Now, I'll say the advisors did a lot better, but often they didn't really fully understand what these terms were meaning and how they distinguished from each other. So that's really important to realize, that there's not that common language. And that means that without that lexicon, investors, first of all, themselves have a difficult time understanding what the heck they're trying to do, right? So if you don't have a language to explain what you're trying to achieve, then it's going to be very hard for you to express that intention in the investments you're making. So that's number one. And number two, a lack of shared lexicon between advisors, a lack of shared language between advisors and investors makes communicating about what you want very difficult. So we have to start with this language. And we think that the lack of language has really led to, an absence of communication. And we noticed a lot of latent demand for responsible investing that wasn't being met. So when you talk to advisors and ask them, how often does an investor come in asking for responsible investments, it was very rarely. But then you asked, how often did they say no when you suggested this to them? And also very rarely. So there's a latent demand that exists for responsible investment, and we think language is a key part of that. Now, I'm going to turn it over to Kevin to walk through some of the other findings we had.
Thanks, Brent, and thanks everybody for attending today. This is a really great opportunity. We hope to impart some knowledge and also to hear some questions from you. So as Brent mentioned at the start of the seminar, we interviewed about 105 individuals, split roughly 50-50 between individual investors and advisors. So this slide here, we're just focusing on those individuals that we talked to that are investors. They may be investing on their own. They could be investing with the assistance of an advisor, or a combination of both. And there's three main kind of themes here that we saw. One is investors that just want to keep their hands clean. So these are the types that don't want to invest, let's say, in traditional sin stocks like tobacco, alcohol, gambling, pornography, as well as increasingly in recent years, oil and gas, these types of firms. Number two is those types of investors that want to push the corporate agenda. What do we mean by that? We're talking about engagement. So investors that really want to, for example, maybe buy some shares in Suncor, not that they really want to profit from it, but they want to have a say. They want to go to annual meetings. They want to be able to put forth shareholder agendas. That's the second bucket. And the third bucket is voting with dollars. So this is all about trying to shape the future, right? So for example, let's say that you drink a lot of coffee and you want to vote with your dollar. So you may buy fair trade coffee. You may buy more sustainable source food. And this can also translate not just with your consumption habits, but also with your investing dollars. I think it's also important to note here is that these aren't necessarily mutually exclusive. It's not as if an investor has to be bucketed into one of these three categories. There is some overlap as well. All right. So in terms of motivations, we tried to think about, as we went through all these interviews, what are investors' motivations for embracing responsible investing? And by and large, about 5 different buckets. Number one, which I think came up the most, is formative life experiences. So we talked to one individual. His father grew up in Jamaica, and they always had lots of difficulties with sustainable, clean sources of water. So that theme really came out with that particular individual. Another individual during her teenage years went to many third world countries, and that was the impetus for why she is so passionate about responsible investing today. We also saw some themes around the profession and the education that individuals had. And this was really interesting. So individuals that, let's say, are engineers, they tend to embrace more technology side of responsible investing. Individuals that are in, let's say, environmental science background, well, they were more concerned, let's say, about good production kind of procedures, or sustainable sources of wood, paper, fiber, these kinds of things. Social context was also important. So the types of individuals that you associate with on a day-to-day basis, if your friends are talking about responsible investing, then by and large, you're probably going to be involved in that as well. And lastly, doing well by doing good. Many people we talked to said they didn't just want to make a profit, they wanted to make a profit while at the same time doing good for humanity, whether that be environmental or social. Okay, so now getting to the advisors, we saw three common kind of themes come here. One is that the types of advisors that want to improve the world. And the reason why they were adopting responsible investing in their advisory practice is they saw themselves almost like a conduit to influence individuals in a positive way, those individuals that come to them to help manage their money. And they could basically tell the story, and in so doing, direct money into more sustainable, environmental, responsible kind of funds or individual stocks. The second one was more of a pragmatic kind of approach from some advisors. They basically saw that the industry is moving towards responsible investing. We see that on the institutional side with investors, pension funds, and they saw the writing on the wall, and they knew that if they wanted to sustain and grow their business in the future, that it would make sense to cater to these types of individuals. And lastly, which I would also slot in as more of a practical kind of reason, is risk reduction. Increasingly in recent years, there's been many reports that show that responsible investing has performance just as good, if not better, than conventional investments, but at lower risk. And again, just like I mentioned with the investor side, I wouldn't necessarily say these are all mutually exclusive. There is a little bit of overlap, or there can be some overlap, but definitely these are three common themes. And in terms of prevalency, I would say that the most common motivation would be the risk reduction, and catering to customer values would be close behind. Improving the world was more of the minority of those advisors that we spoke to. Okay, preconceived notions. So one thing that we saw with many of our discussions was advisors and investors having preconceived notions about responsible investing. And as you can see here, the common elements in the middle were around lower performance. This was one impediment that many individuals had, whether they were advisors or investors, to engage in responsible investing. Another one was low product availability. And I think overall, the reason for this kind of preconceived notions is that historically, if we go back 10, 15, 20 years ago, definitely ESG type funds did suffer from these two kind of constraints. But increasingly, in the last 2, 3, 4 years, it's no longer the case. Another big one was concern over greenwashing. We'll talk about more of that later on, but effectively greenwashing is, what that means is when firms say they're doing stuff, but maybe it'd be below the surface, they're doing some other types of behavior and not really doing what they preach. In terms of differences, preconceived notions that are unique to advisors or investors, there were a couple. The one from advisors, which we saw that was quite interesting, was that some advisors were hesitant to engage in responsible investing discussions with their clients because they didn't want to appear judgy or radical. I think the notion here that maybe they would perhaps lose clients by proactively talking about responsible investing in their discussions. In terms of the investor side of things, one thing that we saw was many investors perceived companies that they were familiar with as being more responsible. All right, so I'm going to turn to a poll here. I'll just activate it.
I'm really interested to see this response.
Yeah, so how well do you think responsible investments perform as compared to more conventional investments? So do you believe that they underperform, perform similarly, outperform, or it depends? Which is always a famous one for academics to respond. So I'll give you just a couple moments here to provide your insights. Okay, so we can see here, are the results shared? I think they are. Okay.
I think so.
Yeah, so what we can see here is that most individuals here today think that responsible investments perform similarly to conventional investments. Some people say it depends. By and large, based on empirical evidence, and again, this wasn't the main purpose of our study, but empirical evidence basically shows that responsible investments perform on track with more conventional investments. So this slide here basically shows for the last 20 to 30 years, a mapping of the general Canadian index, S&P TSX 60, compared to the Yancey Social Index. You can see they pretty well mirror each other, no significant differences there. When we compare it on a US basis, we can see that, especially in recent years, the SRI-based index is outperforming the broader S&P index. All right. As people always say, the devil is in the details, and I think it's important to note here is that in any given year, or even over a number of years, individual stocks can out or underperform, right? So it's easy to say, okay, in 2020, this particular stock, let's say we look at Tesla, vastly outperformed a similar conventional stock, let's say like Ford. All right. And there's other stores that go the other way. So the statements that we're saying is here, overall, broadly speaking, when you look at the equity markets, there's no real difference in returns. All right. So let's look at some of the other points here. Can you go back, Brent?
Sorry.
Okay. Yeah, so first point, increased public awareness around climate change and social issues driving greater consumer demand. So I think this is a really important point. And the notion is, unlike 20 years ago, people are now voting more with their dollars. What I mean by that is they're willing to pay more for sustainably sourced coffee. They're willing to pay more to buy a vehicle that's electric, right? And ultimately, at the end of the day, stock prices are a function of people's purchasing, like the way that they purchase, how they dedicate their dollars. So, right. So if more people are spending money on these kinds of services and products, it's going to translate into profits for these companies, which in turn drives per stock performance. So this is a really, really good reason why we see performance being just as good. Another thing that's evolved over the years is that unlike 10 or 15 years ago, where most of the notion was around sin stocks, more of an exclusionary basis, now many advisors are using more robust analysis, positive screens. And this is also driving better returns for these ESG type stocks. And lastly, what we also see over the last few years is more and more portfolio managers moving from traditional type investments to ESG or responsible type investments, right? But more and more qualified people are moving to manage this money. It's not surprising that performance is also getting better. And also, with more and more funds being invested, the MER fees, management expense ratios, are also getting lower. Okay, next slide.
Great. Yeah, that's good to address that performance elephant in the room. Just a few more points we want to make before we get to some interactive Q&A, just around investors and how they're approaching these investments. One, we're noticing they're not super comfortable yet making responsible investments. And often that's showing up with investors having a second pool of play money that they use. So their retirement money is safe in a ETFs or mutual funds, often with an advisor, and they're playing around with this responsible investment money, which suggests that they feel it's riskier. Right? Other investors finding a lot of trouble and anxiety when they're searching for a perfect responsible investing, worrying about greenwashing, worrying about are they making the right move. So that's leading to, instead of making change, actually just the status quo. I'll get around to it later. I'm not sure what to do. And then the final piece is that some investors seem confused still about, is responsible investing philanthropy? And they sometimes see this as interchangeable. And so we want to get these investors, we think investors should get off out from behind the couch, get onto the couch if this is something that's important to them, and really find a way to enact their values if that's something that they would like. One of the final pieces here is just around investors getting tunnel vision when they're considering responsible investments. We see this with investors assessing the investments they are making using anecdotal stories. So not a full picture of a firm or investment, but rather, one story. So Walmart was an example of an advisor that mentioned, some positive thing that Walmart was doing around labor conditions in their international shrimp supply chain. And that's great. And that story was a positive one, and one that resonated with the advisor, and probably with some of the investors that she was working with. But Walmart is a polarizing company for many. And so, I think it's important for investors to not get too focused or myopic on one element of what a firm's doing, and look, broadly, unless, that particular issue is what's most important to you. Yeah, and I think I just want to move us forward now to talking about how could you get started on responsible investing if you're not there yet? And so we have a few thoughts for you. First is consider your values. Consider what's important to you. I don't think we always think about that as often as we should, but really do a bit of soul searching, figure out what that means. If you look at the poll, I don't know if we can get the poll from earlier, but there was. We asked you, would you be interested in, would you be upset or uncomfortable? Oh, there we go. Look at that. I will share this. Would you be uncomfortable if you knew your investments held one of these firms? And quite a few of you had concerns about Raytheon, concerns about tobacco, concerns about MGM, right? So understand your values as a first step, right? Second is get informed about the options. RIA Canada, the Responsible Investment Association of Canada, has a great website with lots of links to mutual funds, as well as advisors that engage in these kinds of practices, and investigate websites of your advisor, a financial institution you're with, and then engage your advisor. Have a generative conversation about it and get specific, and then create a plan. Your plan has to consider, what you want to achieve and how you want to, what you want to do, but also, practical consideration like avoiding exit fees, for mutual funds that might have trailers or elements like that, and excessive capital gains that you might not want to pay all in 1 year. One suggestion is to maybe start with your RESPs if you're making them, or with TFSAs. They often get regular, yearly updates, and you can pay attention to what's going on with them, and use that as a bit of a test case for you to learn more. I thought maybe we'll end there. We have a slide of resources here that I don't know if there's this point in reading them out, because I want to get to questions, and I want to get to what people would like to learn about. So,
Great, thank you. Brent and Kevin, should we move into some questions and dialogues?
I think we should.
Okay, awesome. Actually, well, thank you for the presentation. It's super informative. I have some questions here I'd like to discuss with you. You talked about lexicons. You share the definitions of ESG and responsible investing, screening, and whatnot. And I think there's similar questions from the audience as well around the differences or similarities between ESG investment, responsible investment, and social impact investment. What are the differences and similarities between these three?
Yeah, that's a great question, Candice. So ESG investing is really kind of like the foundation of some of this, where you understand what are the characteristics, what are the environmental and social and governance characteristics of an investment that you're making? So it's very data heavy, and it doesn't have the normative slant to it. It doesn't incorporate the customer value. So where ESG is about assessing, a firm and looking at what they're doing and making a sense of their practices, responsible investing takes that a step further and incorporates, client values, customer values. What do you want to achieve? Social impact investing is it's a bit of a special case of responsible investing in that it is, kind of at the tail end. When we think about responsible investing, there is a range of outcomes you could have. We often think in finance about the trade-off between risk and reward, risk and return, right? But you can also layer on top of risk and return, social impact. And so for social impact investing, the desire is to have that impact. And you might accept a lower return and a maybe higher risk, maybe lower risk in doing so. But the point is intentionality with social impact investing.
Oh, that's great. Kind of give me some clarity in terms of, it's just kind of how you like to interpret kind of the type of investments you're making and the lens, right? So this is great. So I have another question, and this question actually comes up also quite a bit from the audience as well. So I'm going to combine them together into a kind of a related questions around the notion of greenwashing. So I think, Kevin, you mentioned in your presentation slide, the impediment, right? And in a sense that the preconceived notion to invest responsibly, people are concerned about greenwashing. And the definition of greenwashing here is conveying false or misleading impressions about the nature of a company's products. And how big a problem actually is greenwashing when it comes down to making investments, and how can we investors kind of know when greenwashing is happening and make the informed decisions? Kevin.
Great question. Yeah. So greenwashing is very prevalent in the industry. The one thing that makes it very difficult for individual investors is assessing the extent of that greenwashing. And the whole investment industry is based on trust, right? So I think this is the theme that we've seen many times, is that if you can't trust the company, then why should you invest in it? And one thing that you need to know is that currently there's no audited sustainability reports, broadly speaking, in Canada. So a lot of the rating agencies, so there are a few rating agencies out there like Refinitiv, Sustainalytics, Morningstar, KLD, MSCI. You can get these ratings, but there's a lot of variance in these ratings. And so then as an individual investor, you're left thinking, well, what do I do? How do I do it, right? And it's not really feasible for individuals to do all the groundwork themselves. That's another thing that we've seen many times, where some people try to do all the work and it's just very, very difficult to do. So I would say this: to make more informed decisions, there's a couple of different approaches you can do. If you want to invest in individual stocks, then I think you need to go to these rating agencies, and as I noted, there are a number available, and look for consistencies. So if Refinitiv, Sustainalytics, if they all have consistent ratings, you can put more reliability in those ratings. If you don't want to do individual stocks, there's a lot of good mutual funds out there. And in fact, one of the resources that Brent and I will post on our website later on basically rates the fund managers, portfolio managers on ESG performance. So that's a good way to offload that responsibility to somebody else, and you can actually rely on this type of analysis. I would say too that going forward, there's an organization called the Sustainability Accounting Standards Board, short form is SASB. And right now, those standards are voluntary, but going forward, I think it will become mandatory. And what they're going to do is essentially a company will get two types of audits. You'll get your financial audit, which companies already get, and you also will get a RI type of an audit. And that will increase, I think, the quality and the reliability of companies reporting, and I think reduce the amount of greenwashing that's happening.
No, that's great. building on this conversations around greenwashing and sustainability skepticism, Brent, you and I have a quick conversations prior to the session today. About Tariq Fancy, a former sustainable investment officer at BlackRock. He himself is also, despite his position, is a sustainability skeptic in the sense that he actually quit his job, now running his own nonprofit in Canada, and has been coming out arguing that responsible investing really doesn't achieve what it tends to achieve. And there's a quote actually I found is very interesting. And he said, the climate crisis can never be solved by today's free markets. And he said, it's cheaper and easier for you to market yourself as green rather than do the long tail work of actually improving your sustainability profile. Oh, what's your thoughts on that?
Yeah, there's a lot there, isn't there? I mean, I think Tariq has a lot of really good arguments. There's a lot of potential for greenwashing in this industry. A lot of it can be marketing, especially when it becomes kind of popular and fad-like, which we're seeing in the last year or so. And I think the main point he makes is that responsible investing alone, can't solve some of our bigger problems. And he's absolutely right. I don't think we can responsibly invest our way out of major structural problems like climate change, probably like equity, diversity, and inclusion. And so we need government to take action. We need government to set prices, carbon prices that will create an environment in which investments can be made by everyone that align with the kind of objectives we're looking for, which is reducing carbon, for example. However, I say, governments don't make decisions in a vacuum. And the popularity of responsible investments, I think, is reinforcing government's resolve to say, look, we can be more aggressive on carbon. And I think this idea that sustainability reports will be coming out soon, making them audited, to avoid greenwash, as Kevin was mentioning. These rules are made, not by a government top down, as we like to believe, but by a combination of citizens and businesses that are all got to be part of that decision-making process. I'd also say too that a lot of the investments that are out there are really weak on responsible and sustainability elements. They are sustainability in name, but they might still have pipeline firms or oil companies at their top 10, and that's okay as long as the investors understand what they're buying, right? But there are other investments that are really focused on change, and that they'd be investing in more specialized and more solution-oriented sectors. A final thing I'd say is that I think without shareholder engagement, these responsible investment solutions are going to be hard to take hold. But with shareholder engagement, you've got large investors pushing for change. And that tends to be what firms listen to as well.
Oh, great, thank you. And there are a couple of questions actually from the audience. It's around kind of this transparency and kind of is ESG really all that green and positive? I think you answered some of those in your comments. So I want to kind of bring up a few just to see whether you have further reaction on that. Adrian's kind of talked about, he read about this week about disagreement on ESG between Warren Buffett and the Berkshire's minority shareholders. Not so sure you have any insights about Buffett's ESG concerns, if you have any thoughts on that piece. And also Adrian mentioned the recent enforcement action after investors were sold on bogus ESG investments. How can investor acknowledge and be strengthened, investors' knowledge be strengthened to avoid reputational damage to ESG? So the two questions from Adrian, I thought it's actually quite timely to bring it up here. Just wonder if Kevin or Brent, you have any thoughts on his comments.
I wish I'd seen that Warren Buffett article. I haven't seen it. I'm going to go take a look and see what that is. But definitely, whenever you have different shareholders with different views on how to, how to run an organization, you're going to run into these kinds of minority shareholder challenges. Yeah.
Yeah, Adrian, actually, if you have that kind of article, maybe you post it on the chat and we can circle back to that in a second during the open Q&A.
One article that I have read recently, I don't know if it's exactly related to this because I haven't read the Warren Buffett one either, is that there's a lot of talk in the industry about doing ESG, right? But not really differentiating between what components of ESG are more important for different industries, right? So if you're in oil and gas, is the environmental or the social side more important? I think most people would argue that the environmental side is more important, right? So I think one thing that firms do need to do is they need to do a very serious analysis around what components are important for them. You can't be good at all things. So try to do good in the one or two aspects which are going to drive the most benefit or outcome for the investor, not just the investor, but also for the world. And I think many people think, well, you need to be good in all dimensions. I don't think that's the case. So.
Right. Great. Actually, so okay, Ali had posted on the chat. You can take a look. That's the essential summary of the report, saying that Warren Buffett disregarded the need for ESG reporting despite calls from investors to do so, and there's a skepticism on this. And he mentioned the effort to do reporting for all companies firms invest in would be cost prohibitive. That's an interesting comment.
Yeah. Well, I took a quick look and it looks, without having a lot of in-depth understanding, but this is a great example of shareholder engagement, where like large companies coming together, BlackRock being one of them, the largest one of the largest anyway investment firms, and pushing there for disclosure, and we saw that being successful at Exxon. I suspect it's only a matter of time until it's successful at Warren Buffett's Berkshire Hathaway as well.
Yeah, great. Okay, let's move on to a different topic, shall we? Talk about return. Data has reflected, when you mentioned, that responsible investments do yield similar results, and in the long term, it shows some positive performance. They can actually outperform the market in general based on your data, and definitely they reduce a lot of risks. So maybe share with us about what are some of the underlying fundamentals that make these responsible investments more attractive if we want to adopt a hold and buy strategy.
Yeah, so I think the big thing here is that especially in the last few years, the general public has really recognized the existential threat of climate change, right? So when we see this in the news every day and we see how it's impacting our lives, I think it's in our face, and that's really causing many people to really reconsider what they buy, how they use resources. And again, as I noted earlier, I think that demand, that latent demand, is driving people's purchasing dollars, which in turn impacts profits, which in turn impacts stock prices and returns. And I don't think that was there 20 years ago when we did have some responsible investments there that were available, but the latent demand wasn't there yet. Same thing can be said on the social side. I think it's really just in the recent years that it's really come to play that we see increasing inequality between rich and poor across the world. And that's also, I think, driving many people to be willing to pay more money for products that actually treat human beings and give them a fair wage.
Oh, great. Thank you. Now we're getting towards the last 15 minutes of our session. So there are tons of questions. Yeah. This is great. So I'm going to get to some of the questions, as many as I can, and we have done some of those already. One question from Deep. Deep said, I've read some of your work and thoroughly enjoyed it. He would like you to talk a bit about your thoughts on the Norwegian Wealth Fund and how they have used their revenues, oil revenues, to divest from fossil fuels.
Yeah. Yeah, I mean, this is the ultimate, pension. No, it's not a pension fund per se, a sovereign wealth fund, but this is the ultimate institutional investor making waves and pushing for change, and they've done that. So, a little ironic, most of the wealth fund came from oil, from their offshore oil reserves that they taxed, and now they're divesting from it, and so they're making a big move there. And I mean, it makes a lot of sense for them to do that from a risk management perspective as well. If they're heavily into oil, you'd want to find a better balance. But I think they're taking a progressive stance, and it's being noticed, and it's big money, and it's moving markets. So yeah, I think it's Yeah, I think it's certainly something that everyone's watching.
That's great. Okay, next question. I have actually Gary asked an interesting question. So why do you think institutions such as U of T and Harvard refuse to divest from fossil fuels despite strong calls for divestment? And a lot of institutions have not. It's not just those two. So what's your thoughts around kind of the institutional power, and do they have a responsibility to start divest?
Yeah, it, it's a good question. And based on our discussions, it's actually like the institutional investors and pension funds that were the first kind of organizations to divest. And the reason for that is transparency, right? So anybody can see, okay, what investments, let's say, does a pension fund have? And they were the first movers. So I am a little bit surprised that organizations like Harvard or University of Toronto are not divesting of these types of investments. I guess one reason, which is very just pragmatic, is that some research does show that sin type stocks do outperform. And the rationale for that is if everybody's shunning a certain industry, those prices go down. But as long as they're still generating profits, that can generate a lot of return for these pensions, right? So I don't know enough specifically about these two organizations, but I think that's probably what's going on behind the scenes.
Right.
Yeah, I mean, I'll just add to that, if you don't mind. McMaster's under a lot of pressure these days. Some really well-organized student groups are pushing right now for the Board of Governors to divest, right? And U of T has actually made a lot of progress. That they're well down the path, and they actually have a framework in place. So I think that's happening. But there's a lot of cyclicity in fossil fuels, and I think that is something to keep in mind. And you got to be careful about how you divest of something that's so cyclical and so intertwined with the Canadian economy. Yeah.
Right. No, that's absolutely true. So this is kind of related to Chris' questions. So whether you have any additional comments. So Chris said that companies currently touting ESG investments are adequately meeting investors' needs when it comes to are they actually solving the climate-friendly investment solutions? Because still today, a lot of ESG funds have strong positions in fossil fuels. So if these so-called ESG funds are still kind of really holding strong in some of the traditional, energy companies, are we actually truly seeing a change and a shift? And if there's a shift, how and when would that shift going to come? Just kind of get your thoughts on that.
Yeah, so I do think that we are making a big shift. However, with anything in life, there's always going to be organizations that are being opportunistic, right? So they might label their mutual fund or their company as ESG, even though below the scenes it's not, right? And so one organization that Brent and I have looked at a lot is NEI mutual funds, right? And they do a really good job, not just screening, but actually going beyond that and taking positions in oil and gas stocks like Suncor and trying to make meaningful change by actually having share investments there, right? So I do agree that there are ESG investments that do have these types of fossil fuels in there, and it's unfortunate. It requires more work on the investor side to actually sift through all this information to find the good ones.
Great. Actually, your comments also related to Adrian's question. I think which I called out earlier around investors getting sold on bogus ESG investments, and probably we need to be strengthened to avoid reputational damage in terms of how we can invest in the right thing. Just want to kind of get clarity on. So ESG right now doesn't really have a standardized framework, right? It's also has a little bit of latitude in terms of how funds and how investment firms are actually managing the definitions and how they're rating. Can you just confirm and share your thoughts around kind of the standard? Is it uniform?
Yeah,
Yeah,
it's
so
not uniform. Yeah. Kevin, go ahead. Yeah.
Yeah. So it's not uniform. So it's a little bit like the Wild West right now. As I did note earlier, though, there is an organization called the Sustainability Accounting Standards Board, and it is voluntary, but they do give very detailed rules in terms of the types of disclosure that companies should be making. And I think increasingly what you're going to see is the better firms, I put in quotes, better firms will voluntarily adopt these standards, and that will differentiate the good from the bad.
That's great, and I think in a lot of people jumping on this kind of a ESG bandwagon today as almost kind of a means to kind of boost kind of the market profile and reputation. But I think, as you said, with times when regulations are more stringent and investors are more informed, and that will actually evolve over time. I would like to bring this question up from anonymous attendee, and I think this is a very important question in terms of career choices. What do you think as the career scopes in the field of responsible investing and or social impact investing? There's a lot of emphasis in it, and could we drive a good career in the fields instead of the conventional investment and finance inclined positions?
Yeah, I think it's a great question. And you're going to have to be more selective in where you go if you want to engage in one of those approaches. I think the large investment houses have some roles around social investment, responsible investing, and you can find them, but they're few and far between. I expect that's going to change. Even in the last year that we've been studying this, the change has been dramatic. So I would be expecting more job roles like that. It is the kind of thing that you can upskill though, and you can learn about it as someone that's already in a position. So it's I don't know that it's the kind of completely different career path. Social impact investing, there's a lot of exciting careers there as well. And I think I always feel it's worth following your passion than it is doing something that you're not enjoying. So that I think the opportunity is there and you can make it work.
Great, thank you. Another questions from another anonymous attendee, not sure it's the same one. It's an interesting question. I'm going to rephrase it slightly around, social media. The question is around, social media plays an important role in terms of, disseminating information. And the attendee talked about sometimes the narratives by government leaders can actually influence the perception of companies, countries for investment. So sometimes it would limit the kind of scope or perception and perspective in terms of what to invest, where to invest in, and the reasons for investing in certain things, whether it's human rights issues or chemical manufacturing companies that causing kind of environmental damage. What is your thoughts around the role of social media in terms of shaping the narratives around irresponsible investing?
Yeah, so I think it's very, very strong influence, right? Like I've read papers that look at the impact of traditional sources of information on stock prices, right? Like your earnings reports, company reports, and increasingly it is these social, like Twitter feeds, other social media feeds that are driving a lot of volatility in stocks. Right. So unfortunately, the difficulty is how do you assess what's true and what's not true? Right. So I would hope in the future that there would be some sort of means for organizations to really filter through these types of information and label it as either right or not right. But I don't think we're quite there yet. And to do it on a real-time basis, difficult. Maybe the adoption of artificial intelligence can have a meaningful influence there.
Yes, maybe. Great. Okay, so we're coming towards the end of the hour. I have one question before we're going to wrap up with some of the key insights and thoughts from you. Is there such a thing called irresponsible investment? Is the question. And one can be truly 100% responsible?
It's a great part, and it gets to the core of some of what we learn from the investors and advisors that we talk to. One person's responsible investment is another person's nightmare. So there is a lot of subjectivity in this. I think there probably are, firms that we could universally say are irresponsible for the vast majority of the population, tobacco, perhaps, or other elements like that. But there's a lot of leeway there, and I think the importance is to be true to what you want and what you're interested in doing, and look for transparency. And when there's transparency, then you can align, with what you're trying to achieve.
Well, thank you, Brent.
And I would just add to that. Sorry. I was just going to add to that, like based on our discussions with investors, advisors, there was nobody who said that there's anything as 100% responsible investment, right? And I think the thesis there is that with any investment, there's going to be some sort of negative externalities for some stakeholders, right? So this kind of utopia is something that we would like to achieve, but practically speaking, probably cannot.
No, thank you. Well, with this, I'd love you guys to reflecting on some of the questions from the audience and the presentation today. Kevin and Brent, in this order, do you have any final thoughts that you'd like to share with the audience before we give it a close? Kevin.
Yeah, so I think the main thing here is that responsible investing is great in terms of you can get just as good returns at lower risk. That has been demonstrated over and over again with many empirical studies across the world. Another key point is that it's evolving. We're still in transition, which means it is difficult to find good quality information sources that can inform your decision making. That being said, I think we still need to move in the right direction, and that can be difficult to do, but make use of the resources that both Brent and I are providing. We'll put more up on our webpage, and don't be afraid to ask questions. All right. So many people seem to think, well, I don't feel comfortable asking my advisor about responsible investing, right? But they're there for a purpose, and they should be providing that service to you.
Thank you.
I echo Kevin's comments. I think that's bang on. And I guess I'd just say that RI is a tool, and it's a tool to align your values, your interests, what you want to achieve, and who you are as a person with how you're investing. And so the tools I think are available now to make that happen, and they're there for you to explore and use. And thank you to everyone to attend. It is fantastic.
Great. Thank you very much. Thank you very much, Kevin and Brent, for being here today. Very great presentation. Thank you, everybody, for attending. We have a great turnout today. So a couple of things I would like you guys to keep an eye out on your emails. There will be a survey coming out. Please fill it out, especially if you'd like to receive a report from Kevin and Brent, and make sure that you check the boxes. I hope you enjoyed today's webinar, and continue to check our website for upcoming webinars. And thank you very much for attending, and please take care. Bye.
Okay.